Most M&A deals don't fail because of what's visible. They fail because of what everyone assumes is fine. And that's exactly where even experienced deal teams get it wrong. Hi, I'm Neha, and welcome back to Corporate Penthouse. In this video, I'm going to walk you through 10 red flags in M&A due diligence that are often missed. Not because teams are inexperienced, but because they're looking in the wrong places. These are the issues that don't show up clearly in data rooms, but show up very quickly after the deal closes. Let's start with the reality of due diligence. On paper, it's extremely thorough. You have financial diligence, legal diligence, operational reviews, commercial assessments. Everything looks covered. But in practice, it's often misdirected. Teams spend a disproportionate amount of time validating what's easy to measure and not enough time questioning what's easy to assume. And that's exactly why these red flags matter. Because they don't break the deal before signing, they break it after. So, what part of due diligence gets wrong and why? Here's the core issue. Standard diligence is checklist driven, and checklists are useful, but they create blind spots. What we typically see in deals is over-reliance on structured validation, underweighting of gray areas, and assumptions that go unchallenged. These don't fail because teams didn't look. They fail because teams looked but didn't question. To simplify this, I like to break these risks into 3 buckets. If you remember nothing else from this video, remember this framework. First, financial illusions. Second, operational fragility. Third, strategic misalignment. These 3 lenses will catch what standard diligence often misses. Let's start with the first category, financial illusions. These are situations where the numbers look strong, but the underlying reality isn't. The first red flag is revenue quality versus revenue quantity. This is one of the most common and most underestimated risks. On the surface, revenue growth looks strong, but when you go deeper, 2 things often show up. First, client concentration. If your top 2 or 3 clients are driving 60% or more of revenue, you don't have growth, you have dependency. Second, disguised revenue. Non-recurring revenue presented as recurring. And this is where valuations get inflated and expectations get misaligned. Let me give you a simple example. We worked on a deal where the company showed strong revenue growth, around 25% year on year. On the surface, it looked like a high-growth business. But when we broke it down, nearly 65% of revenue was coming from just 2 enterprise clients. Now here's the problem. If even one of those clients renegotiates or exits, you're not looking at growth anymore. You're looking at revenue collapse. Another version of this is disguised revenue. We've seen businesses classify large one-time implementation fees as recurring revenue to justify higher valuation multiples. Next, EBITDA adjustments. This is where financial storytelling becomes a bit too creative. You'll often see one-time costs being added back, but when you look across 3 to 4 years, they're not one-time, they're recurring. And then you have aggressive add-backs that artificially inflate EBITDA. What looks like a 20% margin business is actually a 12% margin business. Let's say in one transaction, the seller presented an adjusted EBITDA margin of about 22%. Sounds solid. But when we reviewed the adjustments, there were one-time restructuring costs every single year for the past 4 years. So at that point, it's not one-time, it's operational. After normalizing those adjustments, the real EBITDA margin dropped closer to 14%. And that gap directly impacts valuation. The third red flag, working capital distortions. This is a classic pre-sale optimization. Cash cycles suddenly improve before the deal. Payments are delayed. Collections are accelerated. On paper, working capital looks efficient. Post-close, it normalizes and cash flow drops. And that gap becomes the buyer's problem. Now, this one shows up a lot in mid-market deals. We saw a company where working capital looked extremely efficient just before the transaction. But when we looked closer, vendor payments were being delayed beyond normal terms, customer collections were aggressively accelerated. Post-acquisition, once operations normalized, cash flow dropped significantly in the first 2 quarters. And the buyer ended up injecting additional working capital almost immediately after closing. Fourth, Hidden liabilities. These are the risks that don't show up cleanly in financial statements. Off balance sheet obligations, lease commitments, contingent liabilities, and more importantly, underplayed litigation risks. These don't always kill deals immediately, but they quietly destroy value over time. One classic example is lease obligations. We worked on a deal where the company appeared asset light, but once we dug into it, there were long term lease commitments that weren't fully reflected in the headline numbers. Another one, litigation risk. In one case, there was a low probability legal dispute flagged in diligence. Post close, it escalated and resulted in a multi-million dollar settlement. So even if all the numbers check out, the business still has to run. And this is where the second category becomes critical. Operational fragility. This is where most post-acquisition issues actually start showing up. Not in Excel, but in execution. Red flag number 5. Key person dependency. If the business depends heavily on one or two individuals, you're not buying a company, you're buying a person. And the moment that person leaves, value walks out with them. I've seen deals where the founder was essentially the entire business. All major client relationships, pricing decisions, even hiring, everything went through one person. Now, during diligence, everything looks stable because that person is still there. But post-acquisition, once they step back or exit, the organization struggles to function. And revenue starts declining, not because of the market, but because of leadership dependency. Next, process tribal knowledge. This is more common than most people think. No documentation, processes exist, but only in people's heads. So even if systems are in place, operations are not scalable. Let's understand this with an example. In one operational diligence, the company had a fairly sophisticated ERP system. So on paper, it looks structured. But when we interviewed teams, we realized something important. Critical workflows were not documented anywhere. They were just known by certain employees. So when two mid-level managers left within 3 months post-deal, operations slowed down significantly. Red flag 7. Tech stack debt. Legacy systems create integration nightmares. And what's underestimated is not just the cost, but the time and disruption involved in fixing it. A very common situation in legacy businesses. We saw a company running on multiple disconnected systems, finance, CRM, operations, all patched together. During diligence, this is often underestimated because it works. But post-acquisition, when integration starts, you realize it's going to take 12 to 18 months and significant capital to fix. And that directly delays synergy realization. Red flag 8. Culture mismatch hidden as high performance. This one is subtle and often missed completely. High output is often mistaken for strong culture, but in reality, it's sometimes burnout. And once incentives change post-acquisition, performance drops. And now we get to where even the best deal teams get blindsided. Strategic misalignment. This is where the deal looks perfect on paper, but doesn't actually make sense in reality. Let me give you an example. We worked with a company that had extremely high productivity metrics. But when we spoke to employees, the culture was driven by long hours and constant pressure. So performance was being sustained by burnout. After acquisition, when leadership tried to normalize work culture, output dropped and attrition increased. Red flag 9. Synergy overestimation. This is probably the biggest one and the most common strategic mistake. Revenue synergies are assumed without real go-to-market alignment. And cost synergies are calculated without factoring execution complexity. On paper, the deal creates value. In reality, it creates integration challenges. In one deal, revenue synergies were projected based on cross-selling opportunities. But the two companies had completely different customer segments and sales approaches. So in reality, the sales teams couldn't effectively sell each other's products. Projected synergies looked great in the model, but never materialized. Final red flag, market position misread. Growth driven by temporary tailwinds, not real competitive advantage. So when market conditions shift, growth disappears. We saw this clearly during the post-COVID period. Some companies showed very strong growth, but it was driven by temporary demand spikes. Buyers assumed this was sustainable growth, but once market conditions normalized, revenue plateaued or declined. And what looked like a strong market position was actually just timing. So at this point, the obvious question is, if these red flags are so critical, why do even experienced deal teams still miss them? It usually comes down to four things. First, time pressure. Deals move fast. There are deadlines, competitive bids, internal expectations, and under pressure, teams naturally prioritize speed over depth. So instead of challenging assumptions, they validate what's already presented. Second, confirmation bias. Once a deal starts to make strategic sense, teams begin looking for reasons to support it, not reasons to challenge it. And this is subtle because it doesn't feel like bias. It feels like progress. Third, overconfidence in models. Financial models are powerful, but they are still built on assumptions. And what we often see is if the model works, teams assume the business works. But the model is only as good as the assumptions behind it. And fourth, belief anchoring. Once leadership aligns around a deal, that belief becomes very difficult to challenge. Even when new information comes in, it gets interpreted in a way that supports the original thesis. So teams don't go wrong because they don't know. They go wrong because they believe too early. And once belief sets in, due diligence becomes validation, not investigation. So if you're evaluating a deal, here's the one thing to keep in mind. Don't just validate the upside. Stress test the assumptions behind it. Ask uncomfortable questions. Challenge what looks obvious. And pay attention to what feels too clean. Because in most deals, the real risks are not hidden. They're just unchallenged. And this is where most teams get it wrong. They focus on proving the deal works instead of testing how it could fail. And that one shift in mindset is what separates a good deal from a bad one. Because due diligence doesn't fail due to lack of effort. It fails due to overconfidence. And the real discipline in due diligence is not analysis. It's skepticism.